in the fund business. So financial service firms, hedge funds, private equity, and so forth, covering the topics such as directors and officers liability, errors and emissions insurance, cyber crime, and the entire suite of policies and coverages that funds would be in need of. Thanks.
Beautiful. And thank you so much for referring me to Eric. He gave you the name Rainmaker, right? Because he was telling me about the deals you guys work on. So we got to touch on that in just a bit.
Okay.
And Tom, thank you for joining us here today. I know we have a great interview on Fox coming up, so we look forward to getting you there early. Can you tell us, our audience, a little bit about you?
Sure. Primarily, what we do, Great Hill Capital, is a long-short equity manager for accredited investors and qualified institutions. We run money in separately managed account format. We charge no management fee and a performance fee. So that's our primary core business. And then with a value tilt, by the way. And then our secondary business we have a website called Hedge Fund Tips, which is a blog where we post a lot of free research. We have a weekly podcast and video cast, et cetera, that has grown quite a following in the hedge fund community, journalist community, investment community. So we're pretty happy with that.
Awesome. And that's a great blog, by the way, guys. If you have the opportunity, I highly recommend you check that out. And Tom, you and Lewis could shake hands very well because you guys are excellent at marketing. And Lewis, if you recall, I cold messaged you when we started our fund about 4 years ago, and you were very nice to take the time. So I'm very grateful.
Yeah, no, it's been great to watch your firm grow as well as mine. I guess I'll just give a quick intro. I founded a firm 3 years ago called LVS Advisory. It's a registered investment advisory based in New York City, managing separately managed accounts. We manage two actively managed strategies that are on two polar opposites of the risk return spectrum. So I have our two flagship strategies. The first one is what I call the defensive strategy, which is a capital preservation focused strategy, which aims to deliver uncorrelated high single digit, low double digit net returns with limited volatility. And then the other strategy, as I alluded to, is a high risk, what I call a high risk, high return strategy, where it's a concentrated global growth oriented equity strategy, long only.
Beautiful.
Yep.
Well, jumping into it then, and I highly encourage our audience to share any questions if they have any. Tom, I know you're a Columbia guy yourself, so you'd be very proud to know we had a Bruce Greenwald on our show recently.
Wow.
And of course, one of the things he was highly concerned about, as all investors are, is the amount of inflation we're currently experiencing. So what is your advice on that? How can investors better manage their money in their portfolios?
Yeah, I think the worry about inflation is mostly rear view looking. A lot of people are looking for insurance today, but the time to buy insurance is before your house is on fire. So, what we saw in the CPI numbers this morning, it's largely lumped into two things. Number one is energy, and number two is used cars. The used car numbers we see are rolling over, which is a positive sign. And then as far as energy, we have a few potential catalysts that may alleviate some of the short-term pressure. First off is you have talks really heating up with the Iran nuclear deal that could add 1.4 to 1.8 million barrels a day on the market. In a midterm election year, the administration is highly incentivized to get something done on that front. Very difficult to get reelected with inflation numbers like this persisting, as inflation and consumer confidence numbers are linked at the hip. They're joined at the hip. So I do think you're going to see some pressure alleviate on that front. You could certainly see some alleviation with the Russia-Ukraine front. It's in no one's interest to go into a hot war. This is political posturing for sanction relief. And then finally, you're seeing the rig count tick up. So, energy affects everything. It's not just utilities. It's not just gas prices. It's not just heating prices. It's an input cost across the board. And, you're seeing all the classic headlines, $120 oil, $100 oil. And as you know, Paul, we were very, very aggressive in buying both banks and energy in fall of 2020 Those have been monster trades, but now that the whole group, they're all up double and triple, everyone's interested. And in recent weeks, we've actually been lightening up in both groups. You're seeing the yield curve flatten quite a bit since June. It's not to say it can't re-steepen, and it very well might. But I think the best of that trade is behind us, and we're not inclined to be picking up nickels or even quarters in front of a steamroller when there's so much other opportunity out there in distress.
Sure. Right. And just to add to that very quickly, Lewis, you wrote something interesting recently. You said now is a great time to buy stocks. Can you expand on that?
Yeah, absolutely. So January 30th, I published a client note where, basically the message was now is a good time to opportunistically buy stocks. I don't think it's the time to, lever up and, double your gross exposure. However, I think the reaction to what we've seen with inflation, but also clearly an economic cooling, given the tapering off of like stimulus payments, it has been digested by the market. Well, the market has been in the process of digesting it for over a year. It's inarguable to say, in retrospect, that we did not have a bubble in certain areas of the market about a year ago. But if you look at, I guess what I would refer to as like the wreckage post, we've essentially seen .com like correction levels in a lot of those high flying sectors. I mean, even blue chip technology companies are down 60 to 80%, which is astounding. And what a couple of macro, I guess the way I would describe what we do is we're bottom up focused, but occasionally we observe things on the macro side, mostly just from our meetings with companies and executives. From a macro perspective, like if you look at where rates are, I think the bond market is expressing a lot of interesting views. Implied inflation right now, core CPI is up as of this morning, is a reading of 6% up, but the 10-year is still at just 2%. So, I think the only real there's only two conclusions to draw from that. Either the bond market is not worried about inflation, or the bond market is pricing in a recession. Mm-hmm. The stock market is also priced in a lot. And I think the other big point that I would make is that, and I've been writing about this for a couple of quarters now, it's just that it's really misleading just to look at like the broad equity indices at this point. Right. Something like the top 10% of the companies by market cap account for about 60% of the index's market cap. So, the median stock is down way more than what the index shows. And if you take a bottom up perspective, I'm just seeing a lot of individual opportunistic opportunities based on, the wreckage of what we've had in the past 12 months.
Wonderful. Okay, excellent. And then jumping to you, Gordon, I think we discussed on the last interview you and I had together, we actually were speaking with Anthony Scaramucci. And when I asked him what was the key to his success, he listed many things, but one of them that was most important to him was the relationships that he built over a long series of time. So I'm curious to see, in your opinion, how do you build those meaningful relationships to do the deals you do?
Great question. And I think it applies to just about any profession. Relationships are a give and take, and more giving, the more taking you can take. But you can just, whether it's through networking, personal relationships, contacting people, the more you're able to give, you may be able to give to 3 people, like we're talking about our friend Eric. He and I have had a great back and forth relationship. He may be able to give me opportunities to work on, but I may not be able to give him something directly, but somebody in his sphere seems to get something back from me. It just is always an opportunistic environment to give and to receive. I'm not sure if I'm really explaining it, but I think that trying to do the right thing all the time is very helpful for those types of relationships.
Wonderful. Easier said than done, though, right? Because we come from a financial background. So coming out of our shell and putting ourselves out there, networking, is not really the easiest thing to do. And this is something that Mitch Shackles, the president of the Hedge Fund Association, says a lot. He says there's great hedge funds out there, like Tom and Lewis here, that do everything very well, but other hedge funds don't really focus on the marketing and business development. So that was one of the things he pointed out. He said, you got to know how to pick vendors. So I'm curious, Gordon, how do you pick these vendors? Because I can't tell them apart from left to right.
I think, just kind of going back to putting yourself out there, I think everybody has imposter syndrome. They're worried about what people are going to say about them. What if I say the wrong thing? If I go on Paul's show, am I going to sound silly? Am I going to be able to hold my own? And that I do a lot of digital work in video as well as posting. Marketing is just about putting yourself out there. So I would kind of suggest that no one should worry about what other people think about what they say or do or post. Just do it. Put yourself out there. Don't be afraid. Selecting vendors, I think it's really going back to checking references, having conversations with those vendors. Do you get a good vibe from them? Are they, stand-up people? Are they the kind of folks that you want to do business with? The old saying of you can know somebody, you can like somebody, but do you trust them? And I think trustworthiness comes through in a phone call or in a Zoom call. I think it's a very fundamental human characteristic that you can sniff out somebody who's not trustworthy pretty quickly.
Right. Excellent. And then just going back to you, Tom, in reference to what you were discussing earlier, you mentioned that you made a purchase of Wells Fargo about 2 years ago. What is your opinion on international banks here in America? I used to work for Societe Generale, and one of their biggest concerns was capturing market share. What are your thoughts?
Yeah, I think it's not dissimilar to my thoughts on U.S. banks. I think they can certainly push higher from here, but I think the rate of change is in the rearview mirror. In terms of best in class, maybe you start to look at UBS. You always want to steer clear of Credit Suisse. Anything that goes wrong on Wall Street, Credit Suisse is always right in the middle of it. So that's a no touch. But generally, I'd be watching the yield curve here. So yes, they'll benefit from the Fed's fund rate and the first few hikes. But on balance, a lot of that's priced in. As you know, the market's a discounting mechanism, Paul, and a lot of that good news has been priced in. We're seeing C&I loans pick up here in the U.S. That's a positive thing. We're seeing loan demand pick up. But with these things up double and triple off the bottom, a good amount of that's priced in. So we're lightening up. Why? Just to be more opportunistic in groups where there's dislocation and we can get the doubles and triples, and we no longer see that opportunity in banks. We do want to keep some core holdings in Wells Fargo. They'll have the asset cap lifted. That'll be a catalyst. Charlie Scharf is bringing down the efficiency ratio. That's very positive. Citibank is still very, very cheap. But as far as the international, I think there's enough to do domestically that I wouldn't really be playing with the international banks per se here, even though they look cheap. They tend to always look cheap, and they tend to continually get cheaper.
Interesting. Okay. Do you also ever look at local community banks? Is that ever an interesting target for you?
Yeah, that you'd really have to get granular. We'd probably be more inclined in the regional banks to just take a broad basket versus trying to discern which ones are going to get bought up and consolidated. Because that's the real play in the regional banks is the consolidation and the deals. And Anton Schutz is a good bank manager. I'm sure you've seen him over the years on CNBC. He specializes in that game with the regional banks. But on balance, I would buy a basket if I was going to go there. And yes, Wells Fargo has been ticking up of late because they're most exposed to rates. And certainly regional banks will benefit as well. But again, you got to keep an eye on the yield curve, number one. And number two, a reasonable amount of that move has been priced in. Marginally, I think they'll push higher for sure. Would we reload on a material pullback? Yes, I don't see a material pullback in the cards. So we're reallocating some of that cash to where there's actual distress.
Excellent. And Lewis, Tom just alluded to something very interesting. He mentioned that he looks at the management. So I'm curious, when you're analyzing your companies, what qualities and attributes do you look for?
Yeah, absolutely. Prior to founding LVS Advisory, I worked at a quantitative firm where it was just by the numbers. And one of the insights I had, and one of the reasons I started LVS, is because I wanted to have a strategy that would be differentiated from what I think could be very disruptive activity from the algorithms. And judging human character, judging the qualitative aspects of the business is a clearer way that human investors can differentiate from algorithms. And so I do approximately 2 to 3 management calls or industry expert calls per week. And really, I would say a lot of things about it. And doing hundreds of calls a year, you certainly pick up patterns. But what I really have learned to rely on is not to just go by any individual conversation. Really, what I look for is a consensus of opinions across an industry. So, for example, we've done dozens of calls in the online gambling industry, including interviewing the CEOs of most of the major online gambling operators. And every individual person you speak to will have their own bias. And it's important to walk into every conversation and, premeditate, okay, well, what is this person's bias? What are they trying to sell me? But when people step outside the boundaries of their own bias and say something that is unexpected, that, for example, if a competitor compliments another competitor, or if a supplier raves about, someone else down the supply chain, you pick up these insights. And if you pick up enough of them over a pattern of, dozens of calls, it tends to lead to very useful signals for investors.
Absolutely. I love that. We actually had Pete Muller on as well recently from PDD Partners, and that was something. Gordon, tell me something. You know that our main target are institutional investors such as family offices, as is yourself. And one of the things I always think is interesting, and Tom, you would appreciate this, is that they're highly concerned about inflation, right? Low interest rates. But the third biggest concern is cybersecurity. I'm always shocked when they say that. I'm like, what? Do you want me to check your email? What does that mean? Can you tell our audience?
What cybersecurity means?
Why are they concerned?
Sure. So it's a moving target, and it's expanding and getting, riskier and more threatening every day. The variants that existed today are going to change tomorrow, and the experts are, they can only work from what they know. They don't know what else is coming down the pike. I get a lot of emails and newsletters and information bulletins on different cybersecurity issues that are coming around. Today, one was about ransomware threats that we all think only come in via email, but there's a variety of different methods that hackers can attack your data and get into your networks to seize control of them. So the big threat is just losing data or losing control of your information. Whether it's a family office or a manufacturer or a distributor or contractor, everybody's business runs on their data. Lose control of that, you lose control of your business. Whether that's for 48 hours or 3 or 4 weeks, that puts a significant ding in your operating income. It changes the goal structure of the company. We've done a lot of podcasts and conversations around how disruptive cyber attacks of all types are on any type of business. It just is so disruptive.
Absolutely. And I'm always shocked when they tell me they're spending millions of dollars on it. It's a crazy situation that we're in. Tom, jumping back to you. Yeah. There's an interesting thing taking place with Spotify at the moment that we're all pretty much aware of. Do you think some companies are going to back off working with content creators? So for instance, like Adidas with Derrick Rose, and the athlete gets injured and they lose a big contract. Do you think this is something that companies would move back from?
Yeah. Are you talking about Joe Rogan?
Correct. Yes.
Predominantly. Yeah. Joe Rogan holds the cards effectively. If Spotify leaves him, he's got another offer from Rumble for $100 million. If it's not Rumble, it'll be someone else. The bottom line is people are going to pay for eyeballs. I think Joe Rogan certainly made the right decision to apologize for his misdeeds and clarify what he did wrong specifically, and agree not to do that, agree to be more balanced and reasonable moving forward. And so long as he follows through with his promises, I don't think he'll have an issue moving forward. I think he's critical for the health and success of the Spotify ecosystem for sure. So I think that's going to work out just fine. At the end of the day, companies certainly have a set of values, but they also have owners, you have to align both interests. You have to keep in line with your core values, but at the same time, you have an obligation to your owners to continue to grow the business and to continue to generate shareholder value. Otherwise, if the capital flees, you have no business. So it's always a balancing act. I think they've handled it pretty well so far. We'll see if it accelerates or if it fizzles out. But the content creators are really in control right now. If you command eyeballs, if you command an audience, there's always going to be a market for that on some type of platform.
Excellent. And as far as value goes, what other sectors are you looking at the moment? Industries? I know you're interested in biotech.
Yeah, there's no question. Biotech is actually a brand new position, a very large position for us in the last week and a half, 2 weeks. And we effectively looked at the earnings power of the top 30 holdings in the XBI, which is an equal weighted biotech ETF. And what we found is over the last 60 days, since November, thereabouts, the earnings power, the earnings estimates, cumulative estimates for 2022 had declined by about 40 basis points. And yet at the same time, the ETF had declined about 37.5%. So we look for these type of divergences and dislocations. A lot of that was in line with tech overall, the fear of higher interest rates, et cetera. So it was an overshoot in our view, and we wanted to get exposure. We also looked at some quantitative data. If you go back to 1986, to get back to the average price to book multiple, the group would have to appreciate 24%. To get back to the average price to operating cash flow multiple, the group would have to appreciate 155%. That's the most important multiple to us is free cash. And to get back to the average forward PE multiple since 1986, the group would have to appreciate 112%. So right now you've got about 100 companies in the biotech trading at a discount to the cash on their balance sheet. These are situations that we look at that are interesting. This is dislocation. No one wants them. We tend to step in when no one wants them. We can tolerate short-term volatility. We use weakness to add. And then finally, you've got all the drug salesmen are getting off of Zoom and they're getting back out on the road for steak dinners. That's a good thing. Just as we're all going back to the office, everyone's going back to their doctor and finding out they've got a lot more to worry about than just COVID. So that'll be a good thing for Scripps. And then M&A volume in the biotech sector is at near historic lows. The healthcare sector has built up. Their cash available has gone from 100 billion to 500 billion in the last 20 years. And many of the big blockbuster drugs for the big pharma companies are coming off of patent. They're going to have to buy their growth and buy their innovation. And there's never been a better time. They've got the cash and the biotech companies are trading as cheap as ever. So we think it's a confluence of a number of different factors. And we try to just tune out the noise about rates and all of that. Rates will certainly have an impact. I understand the discount rate on future cash flows, but I think it's been an overshoot and I think there's incredible value here. And that's why we've really leaned in the last week and a half, 2 weeks.
Excellent. And Lewis, I see you nod along. What are your thoughts on this?
Yeah. Well, a few things. First, as Tom alluded to, the indices can be very misleading as to the fundamentals of the individual securities underlying. We sit in a unique position where we do merger arb, but also do long only equity investing. So we've actually been the beneficiary on the merger arb side of a lot of biotech deals. So I've seen it, and I agree that a lot of these assets are trading at very attractive prices, actually for both the buyer and the seller, if you believe the pipelines. And I had a thought as Tom was speaking that I'm seeing a very similar pattern play out in the tech space, right? Where there's some of the larger tech companies like Microsoft, who has just announced a $70 billion acquisition of Activision, or a lot of other very well-funded, cash-rich tech buyers who now have an opportunity set of mid-cap and small-cap technology stocks and private companies that have faced a lot of downward pressure on their valuation. So it'll be really interesting to see all the consolidation that plays out on the other end of it, but I expect a lot more deal activity.
Okay, so question for both Tom and Lewis, and Tom, we'll start with you. What are your thoughts on Facebook? Is that a buy?
That's interesting. That is a great question. We actually did nibble on it 2 days ago. It's not anything of material size like biotech or we've been leaning into Alibaba, Chinese tech. But we couldn't resist it at 16 times, even though the growth is going to slow and revenues may be as low as plus 3% to plus 11% with the guidance, which is what really hit the stock. Mark Zuckerberg, the CEO has a way of finding out how to make money, and the platform can't be replicated. Certainly, TikTok has taken some share. We've seen similar situations with Alibaba. Certainly, some share has been eroded, but they've got over 1 billion users. In the case of Facebook, it's many more. And sometimes you just got to take a punt. So, it's very, very small. If it gets weaker, we would probably lean in a bit more for sure. But I think the vast majority of the pain is likely in the rearview mirror. You may have a range, 180 to 220, and that's probably where over the next handful of months it makes sense to add. And if you look at the long-term view, and you don't really even have to buy into the metaverse to believe that. Certainly, the cash burn is material, $3 or $4 billion it impacted. But that said, he's just had a consistent track record of generating cash. And as far as, look, if you were to shut down, Facebook has this reputational issue right now, and they kind of shifted gears from a marketing standpoint to take the focus off the antitrust. But if you were to shut down Facebook tomorrow, you'd probably bankrupt 30% of small businesses in America. That's how important that platform is for advertising. So when you get something trading at 16 times, look, they can always say we were wrong about the metaverse and stop. But if they happen to be right, they're going to have an unbelievable moat. And in the meantime, just because they're doing metaverse doesn't mean small business owners are going to stop growing their advertising on the platform, because the eyeballs are certainly still there and will continue to. It has a level of inertia and scale now, even if they lost 5 or 10%, which they likely won't. At these levels, 180, 220 range, it kind of makes sense to have some exposure for sure. It's not a pound the table high conviction, but it was just kind of couldn't resist type of levels.
Wonderful. It seems like Warren Buffett felt the same way, because he looked at it as well, and he said it's not yet perfect, but it's getting there.
Okay.
Wonderful. But other value guys like Guy Spear, Manish Babrai, and I believe Guantam Bay, they jumped in. So Lewis, what do you think?
Yeah, I'll make a couple of observations. The first observation I'll make is that I don't think you could really, I think you can no longer group Facebook into the same category as the other FANGs. I view it as less of a stable, predictable outcome and more of a potentially high alpha, high beta outcome. And I say that because it's what happened with Apple changing its IDFA tracking and transparency rules cuts to the core of what Facebook's value prop is for advertisers, which is the ability to effectively track and monetize, basically spend advertising dollars efficiently. The insight that we've had is that we have no position in Facebook, but we have a position in a lot of DTC e-commerce companies that spend on Facebook, and we actually saw this coming a couple of quarters ago, just from speaking to Facebook's customers, and they've all said consistently, our ad efficacy, our ad spending efficacy has significantly deteriorated, post IDFA. And that being said, like, Facebook is clearly a very cheap stock. It seems like there's a lot of ways to win. I think one way to win, and a popular way to look at it, is if you think that there could be a regulatory move to break up the company into Instagram, Facebook Blue, WhatsApp, the sum of the parts is likely worth a multiple, certainly a premium to the current consolidated, there's clearly a conglomerate discount on Facebook's assets right now. And then the other thing I would say is that, Facebook still has the lion's share of, this D2C advertising platform market. Mm-hmm. They've seen a deterioration in the performance, but, betting against the company here would be betting against the company's ability to innovate around the current challenges, which I would never want to bet against Facebook's ability to innovate and bet against Mark Zuckerberg.
Yeah, it's hard to bet against Zuckerberg. I love that. I see a couple of questions trickling in here. Right away, one is for Gordon here, and this is kind of in relation to what I was going to ask anyway. Going back to my conversation with Scaramucci, I asked him what type of fund managers does he like to invest in, and he told me, Paul, I don't only like the guys that can generate the alpha, right? That's great, but what happens when times get tough, right? You have to be able to mitigate your downside and manage your risk, both for your investment portfolio and for your business. So, Gordon, how do we manage our risk here?
From an insurance perspective and from a lawsuit perspective, I think
Business.
it's clarity around your business goals, your communication with your customers and investors. We talked about cyber before, hiring the right experts, bringing them in, giving them the budget to do what they need to do to protect the company. Those would be my kind of bullet points on that.
I love it. And then, okay, so two of these are the same here. Tom, this would be great for you. What are your thoughts on what's taken place with Russia and Ukraine?
Yeah, it's something that's completely outside of my control, so I don't spend an enormous amount of time trying to be focused on it. If I can buy things that have a large enough embedded margin of safety in the worst case scenario, like I believe that biotech as a sector has, like I believe that parts of China tech. Look, if Russia invades Ukraine, it's going to have an impact on Alibaba's share price for maybe the next week. But at the end of the day, they've still got over 1 billion users. They're growing exceptionally fast in all of Southeast Asia. Their cloud business is growing fast. And by the way, they've grown revenues per share and cash flow per share by about 600% in the last 7 years. They've grown revenues by 900%. And I'm paying 2014 prices. So for me, if Russia invades Ukraine, it's like, okay, some greater volatility. Maybe it gives me a chance to pick up a few more shares. But beyond that, it's outside of my control. So I really don't let it overtly impact me, particularly because I'm not trading commodity futures in Brent or anything along those lines. And as I said, we've lightened up on our oil positioning in the last